Navigating economic waters. The role of economic sanctions in shaping investment opportunities and risks. Introduction. In the realm of global finance, economic sanctions emerge as a potent tool with far-reaching implications for investment landscapes. Governments worldwide deploy sanctions as a means to influence the behavior of nations, curb undesirable activities, and safeguard geopolitical interests. As investors seek opportunities in an interconnected world, understanding the multifaceted role of economic sanctions becomes paramount. As these measures wield the power to reshape the risk and reward dynamics inherent in international investments. Economic sanctions decoded. Economic sanctions encompass a spectrum of punitive measures imposed by one or more countries on another. Often in response to perceived violations of international norms, human rights abuses, or geopolitical disputes. These measures can take various forms, including trade restrictions, asset freezes, and financial penalties, creating a complex web of consequences that reverberate across economies and financial markets. The dual nature of economic sanctions. Economic sanctions play a dual role in shaping investment opportunities and risks. On one hand, they act as a deterrent, dissuading nations from engaging in behavior deemed unacceptable by the international community. On the other hand, they introduce a layer of complexity and uncertainty into the global economic landscape, presenting both challenges and opportunities for investors navigating the turbulent waters of international finance. Investment opportunities amidst sanctions. While economic sanctions are often associated with risk, savvy investors recognize that crisis breeds opportunity. In some instances, companies operating in sanctioned countries may find themselves undervalued due to the perceived geopolitical risk. As diplomatic dynamics evolve and sanctions ease, these companies stand to benefit from a potential rebound in their market value. Consider the case of a technology firm based in a country facing sanctions. The company, despite being a leader in its sector, experiences a decline in its stock price due to geopolitical tensions. Astute investors, perceiving the underlying strength of the company's fundamentals, may view this as an opportune moment to strategically invest, anticipating a rebound in value once the sanctions are lifted or geopolitical tensions ease. Navigating risks in sanctioned markets. Conversely, the presence of economic sanctions introduces a unique set of risks for investors venturing into sanctioned markets. These risks extend beyond traditional market dynamics and encompass the intricate interplay of political, legal, and economic factors. The potential for sudden changes in sanctions regimes, evolving geopolitical landscapes, and the impact of sanctions on a country's economic stability demand a heightened level of due diligence from investors. For example, a multinational corporation expanding into a region facing sanctions must carefully assess the legal and regulatory landscape. Sanctions may impose restrictions on specific industries or limit access to critical resources, influencing the viability of investment projects. Understanding the intricacies of sanctions regimes and their potential evolution is essential for mitigating risks and safeguarding investment capital. The ripple effect on financial institutions. Economic sanctions not only impact the targeted nations but also cast a shadow on financial institutions with exposure to these regions. Banks and investment firms must navigate a complex web of compliance requirements, as sanctions often dictate restrictions on financial transactions and asset movements. Failure to comply with these regulations can result in severe penalties, making it imperative for financial institutions to implement robust risk management and compliance protocols. Consider a global bank with branches in regions subject to sanctions. The bank must meticulously screen transactions, assess counterparties, and navigate a challenging regulatory landscape to ensure compliance. This heightened scrutiny introduces operational challenges and underscores the importance of a proactive approach to risk management in the face of economic sanctions. The role of geopolitical dynamics. Geopolitical considerations are intrinsic to understanding the impact of economic sanctions on investment opportunities and risks. The geopolitical landscape is fluid, and shifts in alliances, diplomatic negotiations, or the emergence of new geopolitical players can alter the calculus for investors. As nations respond to changing geopolitical dynamics, economic sanctions may be lifted, tightened, or modified, reshaping the risk and reward profiles of investments in the affected regions. For instance, diplomatic breakthroughs or international agreements may pave the way for the gradual easing of sanctions. Investors monitoring geopolitical developments can position themselves strategically. Anticipating shifts in market sentiment and the potential for increased investment opportunities as sanctions regimes evolve. Strategic considerations for investors. In navigating the complex terrain of economic sanctions, investors must adopt a strategic and adaptive approach. The following considerations can guide investment decisions in the face of sanctions. 1. Thorough due diligence. Rigorous due diligence is essential when considering investments in regions subject to economic sanctions. Understanding the legal, regulatory, and geopolitical landscape is crucial for making informed investment decisions. 2. Diversification. Diversifying investment portfolios across regions and industries can help mitigate risks associated with economic sanctions. A well-balanced portfolio is more resilient to the uncertainties introduced by geopolitical events. 3. Monitoring geopolitical developments. Keeping a vigilant eye on geopolitical developments and staying informed about potential changes in sanctions regimes. Enables investors to proactively adjust their strategies in response to evolving circumstances. 4. Compliance protocols. Financial institutions and investors must establish robust compliance protocols to navigate the regulatory complexities associated with economic sanctions. Staying abreast of changes in sanctions regulations and ensuring strict adherence is paramount. 5. Long-term perspective. Investing in regions subject to sanctions requires a long-term perspective. Economic and geopolitical dynamics evolve over time, and patient investors may find opportunities as situations normalize or sanctions are lifted. Conclusion. Economic sanctions wield a profound influence on the global investment landscape, introducing both risks and opportunities for astute investors. Navigating the complexities of sanctioned markets demands a nuanced understanding of geopolitical dynamics, thorough due diligence, and a strategic approach to risk management. As the world grapples with shifting geopolitical tides, investors who grasp the multifaceted role of economic sanctions will be better equipped to identify and capitalize on investment opportunities while effectively managing the associated risks. In the ever-evolving arena of global finance, the astute investor remains attuned to the subtle currents of geopolitical dynamics, steering a course that balances risk and reward in pursuit of long-term financial success.